Today we are going to discuss about Dow Jones theory. Charles Dow and Richard Jones. They are the one who introduced Dow Jones theory. They used to write about various industries and their future prospect in different journals. They were committed to reporting on Wall Street without bias. In the year 1882, they started a financial bureau and named it as Dow Jones and Company. Initially, they started with two-page summary of the day's financial news, which was considered to be important source of news for investors to decide on their investment. Later, they converted two-page summary into financial newspaper. Their main objective was to give full and fairly daily news on stocks, bonds, and some classes of commodities. In the year 1890, they saw recession ending and many mergers taking place in the formation of huge corporations. They encashed this opportunity to form Dow Jones Industrial Average. And first such average appeared in Wall Street Journal in the year 1896. They started by taking 12 industrial averages, that is adding closing price of 12 industries and dividing it by 12, thereby introducing an industrial index. During those time, it was very popular indicator of stock market activity. They started with 12 industries and presently Dow Industrial Index is made up of 30 industries. In the year 1897, they introduced Railroad Index, or we can call it as Transportation Index. According to them, industry produced goods that ran the economy and railroads delivered those goods to the public that enabled the sales to take place. And during that time, railroads were the major mode of transportation in US. Therefore, they felt the need of both the index to identify the trend of the market. This slide is the introduction given by me about Dow Jones theory, how did it start, and the two index, that is industrial index and the transportation index, that they have introduced to understand the movement of the stock market. Now let us discuss about important principles of Dow Jones theory. The first principle that he spoke about was average discounts everything. He says that market reflects all available information. That means that whatever information is available from the external source, it can be fundamental, political, psychological, anything, it will surely reflect the stock price of the market. The second principle of Dow theory is three trends. They have compared the trends to the sea. The first trend is primary trend, which tells us about the market movement. So if the market is moving upward, it's called high tide, and if it's moving downward, it's called low tide. This trend lasts over a year or more. The second trend is called secondary trend, and they are compared to the waves. Secondary trends are these corrective waves which happens on primary trend. These are corrections that are either 1/3, 2/3 or more than 50% of the previous high or low, depending on the movement of the market. That is whether the market is bullish or bearish, and lasts for 4 to 6 months. Minor trend is the last trend, that is ripples seen on secondary waves. These are the minor fluctuations on secondary waves that have no impact on market movement and they last for few days or week. Dow's prime focus is on primary and secondary trend to track the movement of the market, whereas minor trend has no much impact on the market movement. The third principle says that primary trend has three phases. So primary trend in bull market will have first phase, accumulation phase, where these experienced traders and investors start slowly investing in these stocks. The market is at low pace and it's slowly moving upward. In the second phase, it is called as public participation phase. There are more investors who are entering into the market. The price has rapidly started advancing and the condition of the market has started improving. The third phase is called distribution phase, where the trend is confirmed, the market is at its peak and the experienced investors who had invested at accumulation phase has now started selling out their stocks and they are booking their profits and exiting from the markets. The phase for primary trend in bearish market, the first will be the distribution phase. The investors will start selling their stocks as they believe market is going to reverse because the market is at its peak. Then comes the public participation phase. Slowly and steadily public will start participating and offloading their stocks, selling their stocks. And the last is the panic phase where market falls drastically and investors who had hold their shares thinking the market will move in upward direction have incurred a huge loss, whereas the others, the experienced ones, the smart ones have actually sold their shares in the distribution phase. I have taken an example over here. Let us relate Dow theory with this example. So Dow theory has compared the trend to C. So if you see this trend, it is moving upward. So this primary trend is basically a high tide trend and that point A is your primary trend. Over here, point B and point C is a secondary trend. So these are those corrective waves. And if you see this diagram, these corrective waves have moved more than 50% from the previous high. That means usually corrective waves move in the direction of 1/3 or 2/3 or sometime more than 50%. So over here when you look into, it is more than 50%. Now, if you see the fluctuations on the secondary wave, these are those minor trends which has no impact on the market movement. Dow theory only focuses on primary and secondary trend to identify the movement of the market. The fourth principle is volume must confirm trend. Dow says that with the increase or decrease in price, if there is a huge volume added to it, you can confirm the trend movement. So in primary trend, if it is a bullish market, the volume increases as the price moves up, you can confirm that the primary trend is moving upward. Similarly, in the primary trend bearish market, when the price moves down with the increase in volume, it is understood that market is going to be bearish and diminish as they rally. This is the fifth principle where Dow says the average must confirm each other. Dow's theory has introduced industrial average and rail average, and he believes when these two average move in one direction, then only we can confirm the primary trend whether it is bullish or bearish. Not necessarily that it has to move in the same time, but when they move, they should move in the same direction. The sixth principle is a trend persists until a clear reversal occurs. It means the market moves in one direction until there is some interference of external source which leads to change in the direction. Therefore, it is necessary to identify the reversal signals, or what happens is sometimes corrective waves will be misunderstood as trend reversal. So the conclusion over here is that Richard Jones and Charles Dow has never written any books on stock market. Instead, they set down their ideas of stock market behavior in a series which was published in Wall Street journals. Their prime focus was on closing price, and they introduced industrial average and railroad average to identify the market movement. Many authors have introduced their theories in their books, which we can refer. You can also refer Wikipedia or Investopedia for further reference. Thank you.